the local collective investment schemes industry attracted a net inflow of 120 billion rand last year. This as investors turned from cash to unit trust. A switch to offshore investment is also expected as investors become increasingly concerned about the future of the local economy. Let's delve into this right now with Leon Campher. He's joining us from Asisa. Thank you so much for joining us, Leon.
Good afternoon.
So let's just look at overall when it comes to fund inflows last year. We saw inflows into funds, and of course that also perhaps a reflection of where the all share index was last year and where it ended last year. So how would you describe 2012?
Well, 2012 was a good year. I mean, record inflows, 120 billion. I mean, it's interesting, our industry is now the 15th largest in the world, measured in dollars. And it's particularly in the last two quarters, and we've tried to track it, and we think there's a somewhat of a correlation on the decline in the repo rate and suddenly a reaction into mutual funds. And one might say this time, you know, did the repo rate decline a lot? No, but in relative terms it did. And you saw the last two quarters, 60 billion, 40 billion inflow.
But it's not, when you talk about inflows overall, it's not of course, a homogeneous picture, one would call it, because in some spaces there in fact were outflows. So take us through those stats.
I think the investor is getting wise. The bulk of the inflows, about 76 billion, was in actual fact into what we call asset allocation funds. And I think what they're doing, they're saying, you know, I don't want to take these decisions anymore, let the fund manager take it. So that was the most popular category. 40 billion flowed into variable fixed interest and income funds, which says those people that don't want to have equity exposure are shopping for yield. Money market funds outflows, and pure equity funds was only 1 billion inflow.
So talk to us about domestic funds, assets split here in South Africa, and what the key changes we've seen between kind of equity funds, prudential funds, money market funds, income funds, bond funds.
Compared to overseas, our exposure to bond funds is very low.
Sitting at 2%, end of December.
Yeah, and overseas it's probably the second biggest category. Internationally, your biggest exposure is equity, just short of 40%, followed by bond funds. 5 years ago, money market funds were the biggest part of the industry. It's now been overtaken completely by the so-called asset allocation funds, which is your prudential, flexible. That's about 34% of the market. Equity, if you include real estate, which is listed, is about 26%, and money markets are now down to 21%.
So we have, of course, seen that shift. And interesting, if you just look at that survey by Bank of America Merrill Lynch of institutional investors basically becoming more optimistic on equities going forward. I think it was 69% of them say they're equity bulls in the next 12 months. So what does that mean for where they're going to be investing going forward?
Look, the one thing we've said to everybody, if we go back historically, I think even professional fund managers, never mind the man in the street, are particularly bad timers of markets. So I suspect, have a plan, have a long-term plan and stick with it. Don't try and time the volatility, don't try to time in and out. And we're not for 1 minute saying don't have exposure to money market funds, but know why you're in a money market fund. You know, it's for your emergency cash. You want to buy a car, you want to fix your house. You know, a money market fund is not for the long term. And we plead to investors, if you want to go into mutual funds, don't take a 1 year view, 5 to 10 year view and ride it.
What about foreign investing and offshore investing right now at a time where the rand is, of course, decidedly weak, above 9 rand to the dollar? And 2 years ago would have been a good time to invest offshore.
Well,
and now everyone is interested in investing because of domestic factors.
Well, it's a difficult debate. You know, 2 years ago the rand was strong. 3 years ago the rand was strong. And I mean, there are two issues. There's a diversification issue, which is a good issue, but there's also an issue, do you just look at the currency? I mean, 3 years ago, if you'd gone offshore with a strong rand or you'd stayed in this market, you would have made a lot more money. So, I mean, I'd say to those people investing, sure, the currency has a role to play, but it's not only the currency, it's where you choose to invest, which must give you a reasonable return over and above your currency play.
Yeah. Just before I let you go, let's talk about the size of the industry in South Africa relative to other industries. I mean, how many assets are under management in the South African collective investment scheme space, or unit trust space, as we call it?
1.2 trillion. Compare that internationally. The total, or those countries that supply statistics, there's an international association called International Investment Funds Association. Asisa is a member. There are 45 member countries. The stats that are collected, currently worldwide, $26 trillion US. Now, I don't even know in rands how many noughts that is, but it's big.
It's big. But we have grown, and as you say, 15th largest in the world.
15th largest in the world. There is obviously a big difference between number 1 and number 2, which is the States, Luxembourg, and then where we are. But yeah, we in the top 15, so we'll take that.